If you've watched any financial content on YouTube in the last 6 months, you have been told to buy these 5 stocks: Meta, Adobe, Google, SoFi, and Amazon. The narrative is always the same. AI is taking over, the pivot is here, or, my personal favorite, this is a once-in-a-generation buying opportunity. At the Investment Diary, I don't care about the narrative. I care about the numbers. Right now, Meta is trading near 650. SoFi has almost doubled to 26. The question you should be asking isn't, is the story good? The question is the price wrong? Today, we aren't guessing. We are auditing. I have pulled the verified Q3 and full year 2025 filings for every single one of these companies. We're going to strip away the hype and run them through the analyst's 3-pillar framework. This is the exact same checklist institutional investors use to decide if a company is a compounder or just a cash burner. Pillar number 1, revenue quality. I don't just want to see growth, I want to see organic growth. Are they selling more products, or are they just acquiring revenue? If the CAGR isn't above 10%, we walk away. Pillar number 2, the truth metric, also known as free cash flow. Profit is an opinion, cash is a fact. If a company tells you they're profitable, but their bank account is shrinking every quarter, they are lying to you. We demand a free cash flow margin of 10% or higher. And pillar number 3, capital efficiency. This is the one most YouTubers ignore. ROIC, return on invested capital. If I give this CEO $1 of your money, do they turn it into $1.10, or do they burn it down to 90 cents? We look for consistent ROIC above 15%. We're going to run all 5 stocks through this gauntlet. Some of these YouTuber darlings are going to fail, but one of them is trading at a valuation so low it frankly doesn't make sense. Let's start with the one everyone is afraid to bet against: Meta Platforms.
And if you don't like Zuck, I like the company itself and the way that he runs the company. And to say he's not a good CEO is just simply ignoring facts. So that is proven in their earnings themselves. So we see it get below that $600 mark. I'll definitely be adding a lot more Meta to my portfolio.
Right now, the stock is trading around $647, giving it a market cap of $1.64 trillion. But let's put Zuckerberg's empire through the verification test. First, Pillar 1, revenue quality. We look for 10% growth. Meta delivered 26%. They brought in $51.24 billion in just 90 days. And this is crucial. This isn't inorganic growth. They didn't buy a competitor to boost the numbers. This is organic ad revenue. More impressions, higher prices. Pillar 2, the cash flow reality. This is where the bears are screaming. Meta spent $19.37 billion in CapEx in Q3 alone. They are on track to spend over $70 billion for the full year 2025, mostly on NVIDIA chips and data centers. The fear is that Zuckerberg is burning cash on an AI science project. But look at the free cash flow. Even after spending that massive $19 billion on servers, they still put $10.6 billion of cold hard cash into the bank. Most companies go bankrupt spending that kind of money. Meta spends it and still prints $10 billion in profit. Pillar 3, capital efficiency. Operating margins held steady at 40% when you adjust for the tax hit. There is no other company on Earth operating at this scale. 3.54 billion daily active people with 40% margins. The year of efficiency is technically over, but the discipline has remained. Now let's talk management. Mark Zuckerberg gets an A-. He is aggressively pivoting the entire company to AI. He is effectively trying to commoditize the AI model layer with Llama to protect his social media moat. It's an expensive bet, but he has the best track record in Silicon Valley for navigating platform shifts. So, what is it worth? If we run a discounted cash flow model, assuming a conservative 12% terminal growth rate, which is less than half their current growth, the math is undeniable. We are looking at a fair value between $850 and $880. At 647, the market is pricing Meta as if its growth is about to stall. The numbers say otherwise. This is verified undervalued, with about 30% upside. Next up, let's look at the stock that everyone thought was dead money until this year's filings proved them wrong. Stock number 2, Adobe. And if you own this stock, I know you are in pain.
No matter what you really do with the assumptions, even if we go the most stupid disaster scenario, the company grows at 4% revenues, you still end up outperforming the market over the next 3 years. If you do a moderate scenario, you end up doing like 20-25% CAGR. If we do a slightly more bullish, in my opinion, realistic scenario of a little bit faster revenue growth with a significantly higher multiple, you're looking at 30-40% CAGR. This is close to $1,000 stock.
Right now, Adobe is trading at roughly $295. The market cap has compressed all the way down to $125 billion. The narrative is that this company is walking dead. The argument is simple. Why pay for Photoshop when Midjourney and Sora can do it for free? Investors have priced this stock as if it is going out of business. Let's look at the verified full-year 2025 numbers that just dropped in December. Pillar 1, revenue quality. The AI death narrative says revenue should be shrinking. The reality? Record revenue of $23.77 billion. That is up 11% year over year. Is it hypergrowth? No. It's barely passing our 10% threshold, but it proves that professionals are not canceling their subscriptions. They are actually upgrading to verified, commercially safe AI tools like Firefly. But this is why we buy. Pillar 2, the truth metric on cash flow. For every dollar of software Adobe sold in 2025, how much cash did they actually keep? They generated $10.03 billion in operating cash flow. Do the math? That is a cash flow margin of 42%. There are maybe 5 companies in the S&P 500 with margins that thick. While the market is panicking about AI disruption, Adobe is printing $10 billion a year in cold, hard cash. Pillar 3, capital efficiency. What did they do with that cash? Did they light it on fire? No. They bought back nearly $12 billion of their own stock in fiscal 2025. They reduced the share count by over 5% in a single year. They are cannibalizing themselves while the stock is cheap. That is elite capital allocation. So, here is the verdict. At $295, Adobe is trading at roughly 13 times forward earnings. For a software monopoly with 40% margins, that is unheard of. This isn't a growth trade anymore. This is a deep value trade. The boring defense isn't working on Wall Street, but the numbers don't lie. Stock number 3, Alphabet. Currently trading around $330.
Google's more expensive than it has been relative to the past year, but it's still not that expensive given the situation and the dominance that it's shown, and it's only a matter of time.
Total revenue hit $102.3 billion. That is up 16% year over year. But here is the real story. Google Cloud. Cloud revenue accelerated to $15.2 billion, growing at 34%. It is now growing faster than Azure and faster than AWS. Google is currently in a massive investment cycle, spending billions on data centers to train Gemini. Usually, when a company spends that much, cash flow vanishes. Google, however, is so financially powerful that even with record CapEx, their operating cash flow remains meaningfully positive. They are self-funding the AI revolution. Operating margins are sitting at nearly 34%. Remember when investors worried that AI searches would be too expensive to run? Google has optimized those costs so aggressively that margins actually expanded. At $330, you aren't paying for the AI hype. You're barely paying for the search monopoly. This is the safest AI play on the board. Stock number 4, SoFi Technologies, ticker SOFI. If you bought this stock a year ago, congratulations. It is trading near $26, and the bank validation phase is officially over. We used to ask, will SoFi survive? Now we ask, how big can it get?
Right?
If they can end up selling those loans faster, loan platform business would end up spiking. This would end up allowing them to have more money to put into marketing to attract more users, to then go out and, find new products like level 1 options and crypto trading to give more financial services products to members. And it's all one amazing flywheel that we've been betting on, at least for me, since 2021, 2022. And hopefully we get S&P 500 inclusion. It would just be that cherry on top that we would all like as shareholders.
Let's look at Pillar 1, revenue quality. This was the mic drop moment of the earnings season. Q3 net revenue hit $962 million. That is 38% growth year over year. That is the highest growth rate of any stock on this list. Pillar 2, the truth metric. For a bank, we look at net income and book value. SoFi just posted its 8th consecutive quarter of GAAP profitability, bringing in $139 million in net income. Tangible book value grew to nearly $6 per share. They aren't burning cash to grow anymore. They are generating capital. Pillar 3, efficiency. They added 905,000 new members in a single quarter. Because they are a digital bank, they don't have the overhead of physical branches. Their adjusted EBITDA margin hit 29%. They have hit the operating leverage inflection point, where every new dollar of revenue drops almost straight to the bottom line. Is $26 expensive? Compared to where it was? Yes. Compared to where it's going? No. Momentum is strong. I have a price target of $30 to $35, though I would wait for a pullback before I decide if I would want to add to my portfolio. Stock number 5, Amazon, ticker AMZN, trading around $234. Amazon is a tale of two companies, the logistics beast and the cloud engine. Net sales hit $180 billion, up 13%. AWS is the crown jewel here, but the retail side has finally stabilized after their massive cost-cutting program.
Amazon's acquisition in Kiva was genius, and the fact that Amazon has 1 million operational industrial robots versus the rest of the nation of 400,000, and their prediction that they can double their retail revenue by 2033 or 32 without any increase in employees just says to me that is going to register margin expansion.
Q3 free cash flow looked low, just $2.66 billion. For a company this size, that sounds terrible. But you have to look at why. It's good burn. They're pouring every available dollar into AWS infrastructure to capture the AI demand. History tells us that every time Amazon destroys its own cash flow to build infrastructure, the stock rips higher 3 years later. Pillar 3, capital efficiency. CEO Andy Jassy has done a phenomenal job. He stopped the bleeding in the warehouse network and defended AWS market share against Microsoft. My fair value? $275 to $300. It's a strong buy for anyone with a time horizon longer than 12 months. So here is the final ranking based on the verification test. If you want pure safety and deep value, you buy Alphabet and Adobe. If you want maximum growth and you can handle the volatility, you look at SoFi. But if you want the perfect blend of growth, cash flow, and AI dominance, the winner is Meta. I personally own Alphabet and Amazon, and will be keeping a close eye on Meta and perhaps SoFi. Let me know in the comments below what other companies would you like me to cover. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for today's video. See you in my next diary.